Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. Today we're going to be looking at the second largest distillery business in the world, and that is Diageo. But before we get into Diageo, just a quick note, of course, like, share, subscribe. Just a reminder to everyone, this video, and I know some people skip over the intros of the video to get to the good stuff. Hopefully, if you're listening to this, this is important. These videos that Ted and I are putting out are not designed to help you make, to kind of educate you on investments or anything like that. We're interested in helping raise the knowledge and skills for people to be able to read financial statements and to be able to understand and analyze those financial statements. So that is the purpose for these videos. It is not going to be looking at the future. We're looking at the fundamental financials. Now, how you use that information is entirely up to you. It is very important for whichever way you're going to use it. So whether it's part of your investment thesis, whether you want to use this as part of your sales strategy, if you're looking to sell to a company like Diageo, or if you're looking to, if you're going to have an interview with them or someone similar to them in their market, there is no smarter way to come across to an interviewer, and I've been an interviewer to hundreds of people, than if you talk about the fundamental financials and what your contribution is going to be to that. So let's talk a little bit about Diageo. Diageo is, as I said, second largest distillery in the world. They have, about 200 brands that they are selling in 180 countries around the world. And these are brands like Black Label, Bailey's, Smirnoff, Guinness, and a whole host of others. Now, in 180 countries, they have 138 production sites in the world. And they employ, if I look at the latest numbers that I can see, 27,650 staff around the world. So very sizable business. Now, we're going to talk about, it's a public company, so we're going to look at the share price. So stick around for that. But just to give you some headlines, they went public in 1988. Now, if you are a long-term investor and you stuck around, you would now be sitting on a 7,970% growth, which is quite sizable. In the last 5 years, it's 167% growth. And then the last year, it's 128% growth. Doesn't mean there weren't any ups and downs. There absolutely were. So stick around. We're going to talk about that a bit more. But for now, we're going to look at the fundamental financials and help you kind of understand and analyze and draw some good information out of those. So Ted, what do we have for our viewers today?
Okay, well, thank you very much, Moeed. Good to see you again. So this analysis is actually a request of one of our viewers, Liam Kellaway, who was very persistent and asked twice if we could have a look at Diageo. So this is for you, Liam. And once again, do remember to, if you'd like us to look at a company, do message us and we will see what we can do. Can't promise. We do get a lot of requests coming through, so we can't do all of them, unfortunately. And if you want to give us a bit of backstory, you're more likely to push yourself up the list. So rather than just saying, look at this company, give me a reason why you're looking at it. Are you interested in investing them? Are you supplying to them? Are you buying from them? Are you potentially going to join them? And you want to get some insight on an interview. And if you are going to do that, give us a date of your interview. We'll try and get it out before then. So with that in mind, let's have a look at their financials. So it's a listed company, and so their annual report is available on their website. Just look under the Investor Relations tab and you will find this very large document, and it will provide you with lots of information about all of the brands and the people who are running the business and what their strategy is and their approach to the corporate and the environment and ESG and how much they get paid and what their strategy is and all that other kind of mush that companies come up with. I'm sure it's not mush. I'm sure it's very, very important information, but we are interested in the financials. So we're going to be sticking to the financial part, which is on page 142. I think. Here we go. So here is the income statement. So first of all, we are looking at the column in bold. So we're looking at the year ended June 2021. You'll notice that we are quoted in millions of pounds. So top line is the sales, which is 19,000 million. That's 19 billion, nearly 20 billion pounds. Now, interesting enough, these guys do something which not a lot, in fact, very few other companies do, is that they, first of all, they say, look, we're going to deduct the excise duty. So basically they want to say, look, here's the sales, look how much money we have to pay in tax at the top line. Now, very few other companies have to do that, but obviously alcohol is a nice vice, and therefore it's attractive to governments who like to tax them. So they're being taxed on their sales rather than on their bottom line. So they made a very specific point. So all the numbers I'm going to quote are quoted of this net sales number. So this net sales, that's really their true top line. So these guys are going to just showing kind of, gross sales, including excise duties as well. So gross net sales after deducting any excise duties, about $13 billion. The cost of sales, $5 billion. That's about a 40% cost of sales, which leaves them with a 60% gross margin. Now, worth bearing in mind that these guys own some pretty top shelf brands, and what we're really saying is that when you buy that brand, when you buy that bottle, every dollar you pay, it only costs them 40 cents to actually make the content, and the rest is going as a gross profit. So the gross profit of about 8 billion, although of course actually in terms of what you pay, you're paying this number up here, and a fairly substantial chunk, that's over 25%, is actually going in tax first of all. Okay, so you can work out the math if you want that. Marketing, very big number on marketing, so investing in these brands, and then operating costs. Now, just as a little aside, I thought this was quite interesting. I'll highlight it. I don't know if I've got any other information, but the marketing costs in 2021 are almost exactly the same as the operating costs in 2020, which are the same as the marketing costs in 2019. Meanwhile, the operating costs in 2021 are almost exactly the same as the marketing costs in the previous year, and the operating costs in the year before that. Now, I don't know whether somebody's just got themselves muddled and got the numbers the wrong way round, or whether that really is, but it was just an interesting observation on that pattern that kind of slightly jumped out at me. So I wouldn't read too much into that, but what they're saying is that they spend a lot of money on marketing these brands. And if you think about it, you walk through duty free, there's usually somebody there with a kind of a tray of, I don't know, whiskies, and, do you want to try one? And you're like, it's 8 o'clock in the morning. I really don't. Well, okay, go on then, maybe one or two just to kind of see me on my way. All of that kind of investment. So that brand sponsorship will all be in there. All very important to to promoting these premium brands and being able to command the high levels of profitability that we're seeing. So looking a little bit further down, we've got our finance charges. Again, finance charges aren't excessively large. We just compare those to the operating profit, just suggests that these guys have got debt on the balance sheet, as we'd probably expect. They'd have grown by buying brands, and they'd have funded those brands through the issue of debt as well as possibly equity. Still, bottom line, very profitable business here. Here we go, $2.8 billion, up from the previous year. The previous year, kind of
2.8 billion pounds, right?
Billion pounds, sorry, yep. So the 2.8 billion pounds. Sorry, I'm always forgetting which currency I'm in. One of the drivers of the kind of the loss or the lower profitability in 2020 is probably this number here. I mentioned they were the same. Obviously it's $1 billion higher, so exactly. There's an extra kind of $1 billion of costs. We can look at note 3 if we really want to find out about that as to what it actually relates to, but. And then we're back up at the profitability in the previous year. So it looks like they've taken a big hit somewhere in there. Could have been restructuring costs, something like that. Year ended 30th of June 2020. That could have been a reaction to the pandemic, and some big cost going through that as a result of that when the pandemic hit. Anyway, core profitability looking pretty good. If we scroll down a little bit further, I'm just going to highlight the earnings per share. So earnings per share, 113.8 pence per share. 2 years ago it was 130, so it has dropped since then. Last year it was, quite a bit lower, but that's because of this kind of dip as in the profitability, probably due to this this kind of one-off hit on the operating costs. So difficult to kind of look at those three and pull out necessarily a trend from that. A little bit further down, we come to the balance sheet. Just find my balance sheet. Here we go. So here's the balance sheet. Non-current assets. Those are the things we need to run the business. Nearly 21 billion pounds. Biggest number there is the 11 billion pounds of intangible assets. Intangible assets, those you can look at note 9 if you want, but that's going to really be goodwill. That's going to reflect that these guys, they've grown through acquisition. They buy brands. That's what they do in order to grow the business. They've also bought a lot of property, plant and equipment, so they'll buy a business, and then obviously they've got to replace the distilling process or the breweries, etc., etc. And they've got quite a lot of investment, so they don't own 100% of everything. They're going to have a lot of kind of 20% over here, 40% over there, etc., etc., all the way up to 50% in the joint ventures. On their current assets, quite interesting, big number here. So inventories, again, very, very large. And we've seen this in other drinks companies that we've looked at. They hold a huge amount of inventory. I mean, really quite a surprisingly large amount. And I don't know the business that well as to why that is, whether that kind of includes, I don't know, I mean, it may be that they've got, work in progress, and that might be your kind of, your 10-year single malts, which obviously, we're going to distort that because they're going to be sitting in the inventory in the work in progress, and it takes 10 years to mature. So wouldn't surprise me if that's going to have an effect. But it will, it is kind of driving the cash flow of this business. So these guys, they've got a lot of money tied up in their inventory, not necessarily slow moving, but it may be a lot of kind of those long-term maturing assets, which basically they've got cash tied up in. If we go down to the bottom half of the balance sheet, let me just scroll this down a little bit. So we'll just keep that current assets figure on the screen if we can. And so the current liabilities of about 4 billion, really not a problem for those current liabilities if we compare them to the current assets of right at the top of about 11 billion. And therefore liquidity does not look an issue for these guys. There is quite a lot of borrowings on the balance sheet. We expect that. We can see they're paying interest. They can afford that interest, and if they can afford the interest, if they've got good interest cover, it means that they can refinance that debt. They can roll it over. It's not a problem. Although be aware, if you are looking at businesses with a lot of debt, there's a lot of inflation around, and inflation tends to lead to higher interest rates from central banks. Will be interesting to see whether that actually happens or not, and therefore can create headwinds for companies who have too much debt. A little bit of short-term debt as well, and we can take those two numbers together as the total debt and then compare that to the equity that's funding the business. There's the equity down the bottom, and mainly funded through retained earnings. So these are profits that the business have made. They're reinvested back into the business. Okay, so pretty healthy looking balance sheet. Quite a lot of debt, mainly debt funded, but it can afford that debt, and that doesn't seem to be a major problem for these guys. Scroll down a little bit further. So here we're looking at the movement in equity, and just to highlight, I just want to pull out, where do I want to go down to? Here we go. So I want to we're looking at this column here, which is this is the retained earnings column. And you'll notice here that there is a share buyback as well as dividends. So again, in this year, just gone, 2021, there was a little bit of a share buyback, 200 million pounds, and a dividend of 1.6 billion. The dividend very consistent, so they are consistent dividend payers. If you're an income investor, if you're kind of often you'll find that pension funds who are they've got to pay out their pension, they like to buy income rather than capital growth, so to speak. This will be a favorite of theirs. Share buyback, you can see the previous year 1.3 billion, and it's only 200 million in this year compared to last year. So, decisions there, maybe the share price went down. The directors felt this was a good opportunity to buy, maybe bring the share price back up again, maybe take advantage of a dip in the market. Who knows, that could have been when the share price dipped as a result of the pandemic, when everybody's share prices dipped. So these guys, they are paying out to the shareholders. If you buy these guys, you will get a capital. You may get capital growth. You will get an income. Final section is the cash flow, and just a sort of note here, these guys, they are very cash profitable. They are generating cash, which is good. That's these numbers up here, and if we look at the net cash flow from operations, that's the number down the bottom. Again, they are all positive and reasonably strong. Okay, so yes, they are profitable, they're generating cash, they've got pretty strong cash flow, and that's all looking pretty positive to me. What are they doing with that cash? Well, if we push down to the bottom half of the balance sheet, we'll try and just leave those numbers up at the very top. So what are they doing with that cash? Well, they are investing in the future of the business. So here we see the investment activities, mainly purchase of property, plant and equipment, a little bit of business acquisition going on as well. Again, as we said, these guys, they are buying businesses, but they're also selling businesses as well. A couple of years ago, they obviously had, we're in brand X, we don't want to be in brand X anymore, we'll get rid of it. And then, all brand Y, we want to buy into brand Y, we bring it in. So there's a kind of a constant evolving as their strategy evolves, but no massive numbers going on there in terms of relative to the size of this business. Looking at the financing, if you look at these numbers here, this is their refinancing. So this is them issuing bonds and repaying bonds. So in effect, they've got some debt. Some of their debt becomes repayable. They issue a bond, which is basically borrowing money. They borrow money over here, repay it over there. It's not a problem as long as they can service it, as long as they can pay the interest, which they can. So those two numbers, sometimes you see them, they're raising more than they're repaying, which is where they are sort of increasing their debt. And sometimes they're repaying more than they're raising, in which case they are reducing their debt. And that's a kind of, a cash decision along the way. But, there is this refinancing going on, and there is also these dividends. And you see, look at that nice, consistent dividend payer, and it can afford to be that consistent dividend payer as well. So it's not like, a lot of companies, BP, for example, Shell, they've had to cut their dividend because they just couldn't maintain it. They couldn't keep paying at the previous level. These guys, they've got a good interest cover. So, if I was investing in them for that income, I'd be pretty confident that that income wasn't going to go anywhere in the near future. And that's really, the bottom part just tells us, how much cash they've got, 2.6 billion pounds. That's a pretty healthy bank balance for a company like this, which means that it's all looking pretty safe. So these guys, this looks a pretty, pretty nice, solid business, strong balance sheet, good cash flow, profitable. So here is their share price. As you mentioned, if you'd invested when they floated, you'd have made a huge amount of money, but that is obviously the benefit of hindsight, doesn't really help us. We also have been looking backwards, so we haven't been looking forward, so we don't know, does this number continue to kind of, let's go back to that, sorry. So, does this continue on its kind of trajectory like that, and it'll just carry on going up? Does this sort of indicate a takeoff and suddenly it's all going up, or is this actually a little bit of a dip and suddenly it's all going to be going down going down south? Well, I'm not sure about going south. I'm not sure about the first two arrows, but this certainly sort of gives you, if you kind of do your chartist approach, this certainly tells you that, these guys are, they're not going to go anywhere. I think this is a pretty good, solid, staple investment. P ratio of 32 times earnings. That's expensive. That's where the US market is, and the US market in recent days has been wobbling. They've got a dividend yield of 2%. Again, that's not too bad. So 32 times earnings is expensive. A 2% dividend yield does not look too bad, although don't forget, inflation running at 6%, it's not going to cover that. So, I think, this isn't a bargain, by any means. This hasn't got screaming buy written all over it. Also, if you're looking for your 20 bagger, if you're out in the meme stocks and hunting in the Wild West, then this isn't going to excite you. But this is certainly something which I would be prepared to have as part of a diversified portfolio. Buy and hold. You just buy and you just don't look at it for 10, 15, 20 years. Just, literally buy it. Don't even think about it. Write down why you bought it, and then just leave it and ignore it. And hopefully in 10, 20, 30 years time, it'll doubled and maybe even doubled again, and you'll have a reasonable part of your it's the safe end of your investment portfolio, if that makes sense.
Yeah.
So there is Diageo. That's kind of my analysis for you on Moeed. Not a lot else I can add to that.
Yeah, that was I was going to say that's really informative, right? And I suspect the PE ratio is high probably because it's the second largest in the world. It's got good cash flow, good balance, strong balance statement, strong balance sheet, and it's in the alcoholic beverages, which has done pretty well during the COVID pandemic. So it looks like a safe haven, hence why. So yeah, good analysis on the company like that. And look, if you, what are your thoughts, right? If someone watching this knows the industry very well and like to share your thoughts with the community, do so. And if there is another company that you would like us to analyze for you, whatever the reason, and if you can just leave a note in the comment section and also tell us your reason why, and if there are any deadlines for you, that may help push your request up the priority chain. We get a lot of these, as Ted says, so we'll try to get to them as much as we can. So until the next video, thank you, Ted. Thank you, everyone else, for watching this.
Good to see you, Moeed.